All right, let's start. Okay. So today's topic is easy. Uh, I have recorded the other lecture also, the last lecture of the first chapter, right? So you can, it will be uploaded soon, I think. So you can go and watch that as well. So this one is easy, right? This one is comparatively very easy uh, in contrast to the previous one, right? Because previous one was quite tricky because there were a lot of graphs, etc. This is very straightforward, very easy, casual reading kind of topic. And even though the subtopics look quite many, but it's a basic understanding, right? Very basic understanding. So we'll be able to finish this chapter fully today. So that's the point. Okay. All right. This chapter is about understanding business cycles. One module, only business cycles. Few topics here, right? We'll see. There are 9 topics, but only the first topic is long. Rest 8 topics are very small, right? So the business cycle and its phases is little long. Otherwise, there is nothing much in this chapter, right? Very easy chapter, right? So we'll try to understand what is business cycle and its phases, what are credit cycles, what are inventories as business cycle indicators, inventory cycle and labor capital adjustments to be done, consumer sector activity, housing sector activity. Today, some report came out in the US market about housing sector, right? External trade sector activity, business cycle characteristic, and economic indicators, right? So we have that. Okay, let's start. Very easy chapter. Basically, first of all, let's try to understand what is business cycle. See, business cycle, if you look at the graph, which is given below 13.1 business cycle, right? Business cycle refers to the fluctuations in the overall your economic activity, which is measured generally by your real GDP. And you always look at the long-term trend, right? So what we are trying to put across here is that economy does not grow smoothly. It moves in phases, right? There is COVID, which happened, economy went down, then the economy went up, right? So when you look at the business cycle, there are 4 phases of business cycle based on the real GDP. This is from the real GDP. On the y-axis, you can see real GDP, right? So in CFA, pay attention to small things because sometimes they ask you, right? Nominal GDP or real GDP. This is real GDP, right? So that is one point. So based on the real GDP, there is expansion where the real GDP is increasing, economy activity is improving. There is a peak, right? Real GDP stops increasing. This is the turning point before decline. Then there is a contraction, which is recession. Real GDP is decreasing, economic activity weakens across sectors, and then there's a trough, right? Which is the real GDP stops decreasing. This is the bottom after which the recovery begins, right? So peaks and troughs are the your kind of your turning points, not exactly the periods, right? That we should know. So then we have, the curve in the figure illustrates the classical cycle, which is based on real GDP related to the beginning value. Please understand classical cycle versus your growth concepts. Classical business cycles focus on the level of the real GDP. That's why in the graph it is given real GDP. Expansion is equal to GDP increasing and contraction is GDP falling, right? Very simple, very straightforward, like a school kind of stuff, right? Then we go into the next part, right? This is an easy chapter, guys. Not at all difficult. Very smooth, very easy kind of chapter, right? Okay, fine. Then we talk about the alternate measures of the cycle measure, right? Alternate business cycle measure, right? Sorry, alternate business cycle measure. We have to see. So we have growth cycle, which is given here. Growth cycle, what exactly tells you? It looks at how far the real GDP is from its long-term trend, right? Potential GDP, right? That is why in the graph you have the long-term trend, right? If you go back to your graph, which you saw, there is a long-term trend, right? There is the long-term trend and how much you are away, right? Even if you are on the upside, how much away you are, right? So that is what we look at. And again, you measure the percentage deviation from the trend. Economy can grow, but sometimes it can be below trend also, right? So keep that point in mind. Don't think that growth means always up. No, sometimes you have gone down, you are growing up to reach back to the trend, right? That happens, right? So in COVID, the economy went down, then it grew. It grew in contrast to COVID's bottom point. But did it go above the earlier trend? That is a different understanding, right? Then you have, so this is growth cycle. right? And then we have your growth rate cycle, right? Growth rate cycle focuses on the changes in the growth rate, right? So you focus on the changes in the growth rate itself. You measure the annualized GDP growth from one period to the next. So peaks and trough in this kind of concepts shows up little earlier, preferred by economists and practitioners. This is, the favored by your economics and practitioners. Okay. Then your expansion versus contraction, the discussion, small discussion. Again, when you look at the contraction or the recession, first of all, you look at the declines across most sector. Inflation generally falls, growth becomes negative or very weak. Expansion, opposite of all this, it starts at the trough, right? It starts going up, growth turns positive, inflation usually moderate, employment growth kind of lags early in the expansion. Later on, it becomes okay, but early in the expansion, employment growth may lag, right? So small points, just remember this, right? Okay, nothing much here, right? Very simple, straightforward, very easy chapter compared to the previous one. Then technical definitions, like look at that versus your official dating methods, right? So technical definition, when you look at expansion, there is a word. Your economists commonly define expansion as 2 consecutive quarters of positive real GDP growth. So when you watch Bloomberg, etc., right, there normally economists come, they say this thing, right? We are in the expansionary phase because last 2 quarters we saw growth, right? And contraction is the opposite. When the 2 consecutive quarters kind of show negative real GDP, people start saying that we are in kind of contraction, right? Then we look at the official dating methods, right? There is something called NBER. NBER. Basically, it uses your broader indicators, not just your GDP. It looks at your employment. NBER is National Bureau of Economic Research, right? Use your broader economic data, your employment, your industrial production, right? If inflation, everything is given in the slide. You identify the turning point, not your rule-based quarter, right? So you have a different way of looking at things. Then you have key characteristics of your business cycle. There is irregular occurrence, means cycles kind of repeat, but not at the fixed interval, right? Cycle can last from 1 year to over a decade, right? Different countries have different cycles. Applicability, if you think about it, applies to your market-based economies, not typically used for your subsistence agriculture economies, right? Fluctuations, right? Mainly of businesses, fluctuations in subsistence economies or state-planned economies are not considered, right? So small things, please remember, guys. Slide has given everything, so have a bit of idea, right? Fine. Now we have the question from the first one. Based on the typical labor utilization patterns across the business cycles, productivity outputs per hour worked is most likely to highest for what? Now see, the question is asking you, based on the typical labor utilization patterns across the business cycle, productivity is what? Output per hour worked is most likely to highest. Now, when you see such kind of question, basically productivity, when you talk about, right, productivity is generally highest at the bottom of the of a recession, right? Why it is highest at the bottom of the recession? Let me explain, right? Basically, at the bottom of the recession, generally, you know that in recession, people, lay off. Yeah? There's a lot of mass firing and layoffs, right? So firms have already decreased their employees, right? So employees numbers have gone down, right? So employees have gone down. Now, since employees have gone down, remaining workers and remaining capital, what you have, are used very efficiently, right? That is but normal, right? In any world, when there is a recession, what happened in COVID, right? You try to remove all extra workers, right? So productivity, right? The question is asking about productivity. So it's an application based question. So employee goes down, right? So obviously now you're looking at productivity. So your output generally is near about same, but since employee goes down, your hours also goes down, right? Because this leads to this. So obviously if the denominator is down, right, the overall effect is up now. So productivity is likely to be highest in the bottom of the recession. Okay, so keep that in mind. Again, it's an application-based question, right? you have to little bit think about it, right? This is what your okay, and you can remember some pointers also, right? End of the recession, firms will run lean production to generate maximum with the fewest number of workers. Very common sense kind of thing, but yes, have an idea. Then we move on to, as the expansion phase of the business cycle kind of advances from early stage to late stage. Now, expansion of the business cycle from the early stage to late stage, businesses most likely experience a decrease in what? Right. So, do you experience a decrease in your cost or capital investment or availability of your qualified workers? Right. Again, see, when expansion right, expansion matures, right, please understand your labor market tightens, right? Because you see, right, initially when things start getting better, right? So, uh, you know, people's salary increases, company wants to hire more and more talent, right? So, I'll tell you my experience also, right? I have seen people's salary increase a lot of in 2022. In 2022, just after COVID had finished, every economy was expanding. I was hiring somebody. People used to ask 80% hike, right? People used to ask somebody you are hiring, person will say, I want 80% hike, right? But there was so much of crunch of people that people ready to give it, okay, let's give him 50%, hire him fast. But then 2025 came, right? 2025, now we are like stabilized a little bit. Now people, even if somebody asks 30% in the market, nobody gives, right? People say, no, 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 not 30%. I'll give you 10% hike. You want to join? Join. There is a lot of talent in the market, right? Especially in the banking sector, right? This has gone full circle. Like salaries were high in 2020. People were asking 80% hikes in your uh, jobs. Now even 10% you hardly get, right? If you're switching jobs from one company to another, right? So this is expansion kind of matures, right? So I'm talking about expansion maturing is 2025. This is 2025, right? So the labor market kind of tightens because obviously there is oversupply. People are not growing their job. People are looking for efficiency, right? There is oversupply of labor, right? And so that is what the whole thing, right? So in even if right, even the labor market, yeah. So expansion matures, labor market tightens, right? Labor market tightens. So actually, oversupply will not be there. Sorry, your uh, there will be oversupply, but oversupplied of your uh, what do you say, low skilled labor, right? Highly skilled labor will still be scarce, right? So this is very dichotomy, right? So this is where AI people are saying now that if you know AI, etc., you are valued more, right? So people who have skills in machine learning, AI, large language model, they are getting a lot of salary. I don't know how many people have known that Mark Zuckerberg hired employees for Meta and all that, right? At very high salary, right? So labor cost, right? Overall effect here is that when the expansion matures, let me write down the full effect. This is where the confusion comes, guys. So full effect is that what will happen when the expansion phase matures is that your labor cost, overall effect is the labor cost kind of increase. You have to invest in your AI, etc. Right? Think of this period, 2025, you have to invest in AI and all that. Right? So this doesn't decrease. So generally decrease in availability of qualified workers. This is what your AI talent which we are looking at now. Right now, everybody is searching for AI talent because everybody wants to build models of large language models, right? LLM, Chat, GPT, etc. Right? So this is the 2025 scenario. This is what is going on 2025-26, right? So this is what we have. So a little tricky, but yes, easy. So this is what we have. Then we have question number 3. An analyst writes in an economic report that the current phase of business cycle is characterized by accelerating inflationary pressures, right, and borrowing by companies, right? So inflation is increasing, right? Inflation going up, right? And there is a borrowing by companies. Analyst is most likely referring to what? See, whenever the inflation is increasing, right, and even the borrowing, right, is also increasing, right? Generally, right, you will be in the uh, top phase, right? Obviously, you will not be in the contraction phase, right? Contraction phase will not happen because contraction phase, why will company borrow? Company will lay off people, right? So this goes away. Early expansion phase of business cycle, early expansion phase, yes, companies will borrow, but accelerating inflationary pressure will not happen. Accelerating inflationary pressure generally comes, right, when you have reached a kind of a stable thing, right? Where, not in the early part, in the middle part, right? In the middle part, this generally happen, middle or the end part it happens, right? So early expansion, no, right? Early expansion, no accelerated inflationary pressure. It is your peak of the business cycle, right? So in this, you peak or maturity, you can also say. Okay. So easy, not difficult, easy questions. I think that would make sense, right? Uh, Accelerating inflation and rapidly expanding capital expenditure typically characterize the peak of the business cycle. During such time, many business finance the capital expenditure with that to expand their production capacity. Okay. Now, now we go to the second topic, right? Second topic is, again, this is one line, like one slide kind of topic. We have credit cycle. Again, as we had business cycle, now we have credit cycle, right? A credit cycle refers to your cyclical changes in the interest rate and loan availability that move with your economic conditions, right? So credit cycle, if you look at during expansion phase, if you talk about lenders are things are expanding, lenders are more willing to lend, interest rates are lower, trade conditions are loose, borrowing increases. When it contracts, there are a lot of failures, lenders become more cautious, people are losing their jobs, and interest rates rise to compensate for higher rates, credit availability tightens. And if you look at the credit cycle and the business cycle, right, together, right, credit cycles can amplify your business cycles, right? That is why your government has so strong control on your banks, right? Regulation of banks, right? Because credit cycles can amplify business cycle. Easy credit cycle during expansion can cause asset bubbles. When bubbles burst, right, contraction become deeper and longer. That is what happened in your subprime mortgage crisis, 2007-9 crisis, because every person was taking loans to buy properties, etc. Right? Then, if you look at your impact of economic volatility, right, that I've already explained, right, tend to be stronger while contraction become deeper and long lasting. If you look at timing consideration, credit cycle and business cycles do not always speak together, right? So this is very important line. They might ask you an exam, do not always speak together. Trade cycle are typically longer in duration than your business cycle, right? So this is what you have to understand. Easy, 2-3 points I have highlighted, nothing else, very easy. Then we have inventories as a business cycle indicator, right? So here you're looking at inventories as your indicators. Okay, so why inventories matter? First of all, inventories matter because firm balance your meeting of your sales demand versus your tying up of your capital, right? So you're trying to balance two things, right? You want to balance the sales demand while avoiding excessive capital tied up to a inventory or the stock. Stock here is not the stock price, it's just inventory, right? So inventory behavior, if you start understanding inventory behavior, provides you early signals about the economy. That's why people say that, okay, in Mumbai, like in India, I'm talking about in Mumbai, Gurgaon, how many houses are not being bought, or what are the sales of houses, etc. Right? Then you have, so this is one ratio thing, right? Then you have inventory sales ratio. This is what I'm talking about. Tends to return to your normal level during your steady growth. It is watched by your key indicators or key analysts, right? At your expansions, sales growth kind of slows, right? Now, this sounds very contradictory that at expansion peaks, right? Sales growth starts slowing because when your expansion starting, it grows. Then it start causing, slowing down, right? Sales growth slows. There are unsold inventories which kind of accumulate, and there is inventory to sale ratio which rises above normal, right? Then we have firms response. Firms, because they see that something is not getting sold, so they cut the production. This reduction leads to economic contraction. And then we have GDP statistics, which we try to understand. GDP statistics count all inventory increases as economic outputs, whether they are planned or unplanned, potentially masking your underlying economic weakness, right? So this is very important line. Again, I'm making a star, right? So idea here is that please keep in mind that GDP is counting all your inventories as output. Now, it includes planned and unplanned inventory buildup, and this can kind of mask your business weakness because rising GDP driven by your inventory buildup, which is not being sold, it is actually a sign of your future slowdown, not your strength. That is why when houses in China were not being sold, people start saying that China's property sector is now facing a lot of problem, right? So I hope you're understanding, right? It means that if you are saying I'll keep building, things are not getting sold, right? It means we are heading for a disaster, right? So keep that in mind. Analysts focusing solely on GDP growth without examining inventory sales may misinterpret a lot of signs, right? Okay, so keep that important thing in mind. Easy thing, guys, nothing difficult here. Then inventory cycles and your labor capital adjustment. Inventory cycles and labor capital investment, right? So at your contraction, right? At your contraction troughs, right? Inventories are depleted, obviously, right? Nobody is manufacturing. You are in the bottom of the thing. People are worried, right? Sales start beginning to rise now because worst is over. Inventory to sales ratio start falling below normal, and firms start responding by increasing output, right? So you have to understand that after trough, you start seeing better things, right? So firms avoid your what you say costly frequent hiring and firing by first adjusting your existing workforce utilization through changes in your output per hour and overtime adjustment, right? That is, we understand whenever things go bad, firms avoid your frequent hiring, first adjust your output per hour and overtime, and hiring or layoff only when your trend looks kind of permanent, right? Then there's a capital adjustment strategy also, right? Firms initially, right, kind of, right, use your existing existing plant equipment more or less intensively rather than buying or selling assets, right? So they do that. Okay. And next is your during your persistent expansions, firms invest in additional thing, right? When you think that, oh, I'm growing, right? Let me buy more plants, I have to manufacture more, right? So when you're planning a business, these all things matter. Firms reduce their capacity by cutting your maintenance, delaying equipment replacement, right? All these things. So what you are trying to understand is that uh, there is, as the inventory cycle changes, people do adjustment in your uh, labor and capital, right? You want to hire more, you want to hire less. You want to buy additional plant, you don't want to buy additional plant, right? So there are adjustments which are done, which you should know. Okay. Simple common sense, just have to revise once. Then we have consumer sector activity. Again, this is tracked, right? Consumer sector activity. This is again a point. Consumer sector activity we'll talk about. Consumer spending is the largest component of GDP. That's why people track it. That's why there is a survey in US called Michigan survey, which comes out every 2 weeks. Michigan survey, what are the inflation expectation, right? You can Google it. So US market tracks it. So consumer spending is the largest, what you say, component of GDP, depends on your current income, your expected future income, right? So this is very important to understand. Okay. So current income, future income expectation, right? So increasing during economic expansion. Then you look at the durable goods also. Durable goods, why? Because durable goods are most cyclical, highly cyclical due to their higher value, while consumers are willing to purchase items like appliance, furniture, automobiles during expansion. When economy income rises, things become better, economic confidence is strong, right? Then you look at your services also, right? So durable goods purchases are often postponed during your contraction and sometimes into early expansion phases as consumer wait for greater certainty and etc. etc. Services, when we look at services, kind of positively related with the cycle. So services are less volatile, right? Please remember this word, services are less volatile compared to your uh, durable goods, right? Less volatile, and then a mix of your discretionary, right? Both are discretionary and less discretionary. Discretionary is travel, lodging, restaurant. The non-discretionary is which is mandatory, right? Telecommunication, healthcare, insurance, right? Then we look at non-durable also. So durable, services, non-durable, right? Non-durable are least cyclical, right? This is less volatile. This is right, least cyclical, right? Non-durable goods are least cyclical in nature. What are non-durable goods? These are your essential item, right? So whatever you like, your food, your household item, right? And here the spending will remain stable, right? I told you, because even in COVID times, people have to buy your food items, right? So if you think about cyclicality ranking, right? Cyclicality sensitivity, the highest is durable, obviously. Then you have services, and then you have your non-durable goods, right? So that's what we have. Easy, just remember final points, nothing difficult here, okay? Then we go to housing sector activity, right? Housing sector report came out today. I was just seeing, which was out some time back. I think 8 o'clock around it came out, right? So that is what we have to, people track housing report, people track all those things because that is what gives an idea, especially and this is especially tracked in not in countries like India, because India is a country which is dependent more on services, etc. But especially developed economy, right? US, Japan, UK, right? Even China, right? So these markets are heavily dependent on your housing sector activity, right? And you know that, right? Financial crisis was due to your housing sector activity, right? So why housing matters? Because it is your smaller share of GDP, we understand, but it shows your large. Uh, what happened here? Where did I go? Why this sudden switch? Just a second, guys. This. Mm, what happened? Mm, I don't know. I pressed something. Mm, some other tab open. Mm, fine. You are seeing this. Then you were here. Fine. Mm, okay. So why housing matter? Because even though we understand it's a uh, smaller economic component, right? So don't think it's a big component, right? It's a okay. So smaller economic component. The housing sector's large cyclical swings, right, create your what you say disproportionate effect, right? Uh, Okay. So on your overall economic performance, right? Financial crisis, right? The whole financial crisis, uh, okay, for this reason. Okay. So keep that in mind, right? Housing sector is because the amount is, a house in US, right? I think you know that, right? $1 million, right? Kind of thing, right? So large cyclical skills have outsized economic impact, right? Keep that in mind. What are the key drivers for this sector? This is very important because this is a US exam, right? Ultimately, you have to understand CFA, FRMR, your US based exam, right? So in FRM also, when we study risk management, you study all this housing sector, your Fannie Mae, FNMA, right? Your FNMA, your FHLMC, right? I'm not, these are not part of syllabus, but I'm trying to say GNMA, right? So this is called Fannie Mae, right? Federal National Mortgage Association. This Federal Home Loan Mortgage Corporation. This is Government National Mortgage Association, right? So these were the agencies you study a lot in FRM, right? Because these were related with housing, right? Similarly, here also we have to understand, right? So uh, not relevant in all countries, but since this is an exam which is US based, this is important to understand. Uh, then you understand that what are the key drivers? Key drivers are obviously your mortgage rates impact. Please understand when you have low rates, which were there in before financial crisis, everybody start buying, higher home buying and construction. High rates, there is low demand. If you look at housing cost versus income ratio, housing activity rises when your incomes are high relative to your housing cost, right? So that is very important. And income increases, obviously people will buy. If you are kind of late expansion cycle, housing prices may rise faster than your income, right? So housing demand can decline even during your economic growth if home prices rise faster than income, right? Particularly late in the expansion, right? So small points, guys. These are observed in the market, right? That's why we have. Then we have speculative dynamics. Speculative dynamics is that your rising home prices attract your speculative buying, which happened in your financial crisis, right? This is what created problem leads to your overbuilding and bubbles, which happened in China also recently, 2020, 21, 22. Bubble collapse causes your sharp price declines and reduced activity. Then you look at the demographic influence. Generally, people from age 25 to 40 years drive the housing demand. Uh, and this age group experience peak household formation. This has been seen in the data. And the migration pattern also, rural to urban migration increases housing demand, which has happened in all the developing countries and developed countries, especially in industrializing economies, China, India, right? So that is what we have. Again, small points, but just have an idea. Okay. Then we have your external trade sector activity. This is very important. Again, uh, every monthly this kind of data comes out. India watches it very clearly that what is our current deficit, right? Few days back, India data came out, right? I think last Sunday it came out, India data, and that clearly showed that India's current deficit, right? Current deficit of India. Current deficit is basically your difference between your again, this is I'm just telling you difference in your exports and imports, right? Exports and imports. This came out last week, and as soon as the report came out, right, I update my investors, right? As soon as it came, the report came on Saturday, I think Friday evening or Saturday it came out. As soon as it came out, I updated my investors that Indian currency will see a fall, right? Because current deficit has increased, right? And I told them, right? I told them very clearly that uh, we are going to 92, right? USD INR going to 92, right? And within a week, right? Within a week, today we are at 91.6, right? So I can show you also, right? So if you want to see within a week, Indian currency suffered thing, right? So we track all these things. This is how. So if you go to USD INR, right? So see this 91.63, right? And this all has happened in last 5 days. We were at 90.5, and here the report came out, right? Here the report came out. I hope you can see, right? Here the report came out on Sunday, 5 days back, right? 5 6 days back. It came out Saturday. So 90 point something. In fact, less than that. Look at that date was 90.3, I think. Today's 21, right? Yeah, 14. I think around 14 it came out, right? And I wrote in my note which I sent to investors that we are going to 92, and it is 91.63, right? So I'm just telling you a live example which people like me follow, right? So simple point is that you track the trade sector activity. You're tracking, right? How much export our country is doing, what is happening, right? So if current deficit is increasing, that's bad for a country like India, right? So GDP versus your currency effects, right? That is what we have. GDP effects on trade are direct, currency effects are complex and slower, right? Imports, if you
Can I
see,
ask you something?
yeah, go on.
So, how do you quantify this currency decrease? Like, how did you know that it'll go to 92?
So
And
that
also,
is, yeah,
it
go
was
on.
such a huge, I mean, a related question is that in finance, there's such a huge amount of effort that's going into option pricing because of the exact trying to quantify exactly how much it should be priced at. But then, is there a similar effort that's going into the effect of currency appreciation and depreciation? Because how do they quantify how much exactly exports will go down if currency rises by such and such amount, and vice versa? And then, like, to determine which is a better, like, a optimal pricing for that currency against the US dollar.
Okay, so currency is very complex, guy. Like I'll tell you very honestly. See, why I said 92, because 2 3 months back, we see this data sometimes comes quarterly, right? So this was, I think, quarterly data which came out. When the data came out in October, right? That time Indian currency almost like I think uh, November. If I take it like 1 year data, uh, so somewhere the data when it came out, yeah. So 15 December, right, is a monthly data. 15 December, we were at 19, same, see this. 14 January data came out, 15 December. 15 December value we reached was 90.78, right? So it was almost like 91. And then there was few statements, since this is a very logical thing, right? So I was tracking few of things, that what is the response of our government, Indian government, our central bank, etc., right? So I was tracking that. So when we went to 90.78, then your RBI intervened. The central bank intervenes. Central bank does what? Central bank generally, whenever they say their currency is depreciating, right, they will do what? They will sell USD by INR, right? Because central bank has billions of dollars, right? When you sell USD by INR, Indian rupee, then obviously the currency will appreciate. So this spike, you can see that this sharp downfall you are seeing now, the sharp downfall which came around in a week from your 90.78 to 89.57. This happened because Indian government almost did a bulk buying of 10 to 15 billion dollars of rupees, right? So that happened. So Indian currency is controlled currency, right? See, currency are not free, right? China is also controlled currency, India is also controlled currency. So I knew that government action can only save Indian currency, right? Government saved it. Again, currency started moving up, etc., etc. And again, everybody was watching this data, right? Like professionals were watching this data. Now, as soon as this data came out, I was very clear that, and few days back, right, before this 14 data came out, before few days back, our Indian RBI governor had given a statement that there is no hard line for currency, right? So we will, like somebody has asked in an interview that will you keep intervening in FX market to control the currency? or is it you have a red line number that the currency should not cross 90 rupees, etc. Then he has said that there is no red line for me. We will keep doing it till the time it helps our exports to fight in the international market, right? See, depreciation of currency helps your export. Again, this is very complex, right? If you want to help your export, depreciation helps. That's why China deliberately keeps its currency devalued, right? Because if you want to keep the exports better, you can't let your currency appreciate, right? So again, this is complex. We will see it ahead. But idea here is that if you are export driven country like China, you have to keep your currency depreciated, right? And India right now is suffering from 50% of tariffs from US. So India is trying to keep, because if you don't help your exporters, there will be massive job loss in the export market in India, right? Manufacturers will have massive. So Indian government is also under pressure that they want to help the exporters, etc., because there will be loss of jobs, right? So ultimately, Indian government is trying to help the exporter, right? So Indian government is not intervening. So when he said this statement that we don't have a hard line, so I got a message indirectly, right? That since I track market, that it means he is giving a hint to the market that if this time data comes bad, we will not intervene, right? So as soon as the data came back, I was very clear that most probably they will not intervene. So again, that was a probabilistic assumption, right? You have studied, statistics, right? You take probability, right? So probabilistic assumption was that if Indian government doesn't interfere, last time if we have the highest point was 90 point whatever 78 or something, so we are going much above that, right? So much above that is what, 1 rupee ahead at least. So 91.78. So I was like, we will go around 92, right? So my assumption, right, was based on pure macro perspective, right? It was more pure macro perspective, because in this kind of thing, even though you can do some kind of modeling, right? You're looking at data, etc. But the problem here is that here government keeps on intervening because it's a controlled currency. So whatever model you build, it is not a free like stock price or option pricing where where there is no government intervention. See, stock price, etc., there is no government intervention. So that will free float on supply and demand. Here there is a lot of other things also moving, so you have to take in mind, what actions being taken by other players, right? So pure economic modeling generally doesn't work on controlled currencies. India is a controlled currency. India currency is not that controlled as China. China is extremely controlled. China has, I don't know if you know that or not, China has two currencies. One is their internal, which trades inside their country, and one is for which trades in Hong Kong. So Hong Kong currency is not controlled, but your currency inside China is controlled, right? So again, it's a very complex topic, but I hope you got the idea that there you can't just rely on economic modeling on the currencies similar to your option price. Make sense?
Yes. Okay.
So yeah. So next is your domestic GDP growth impact on imports. Same thing, right? If your GDP goes up, right, your imports also go up. Increasing domestic GDP growth leads to higher purchases of foreign goods imports. And if GDP goes down, right, it is vice versa. Now, if foreign GDP, right, exports volume depend on your GDP growth rate of trading partner economy, right? So if US economy is going up, right, our exports will go up, right? Because we will sell more, na? And if foreign GDP is going down, exports will go down, right? So currency appreciation effects, I told you, domestic goods become more expensive if the currency appreciates, right? Currency, INR goes up. Please remember, it is bad for exporters, right? Whenever your currency appreciates, it is bad for, just remember, right? It is bad for exporters, right? And best way to remember is like you will always get China. Please remember every day morning, Indian time, 7 a.m., right? 6:45, 6:30 a.m. or 6:45 a.m. or 7 a.m., right? China fixes the currency level, right? And if you see Bloomberg or somewhere, you will know that, oh, today China fixed China currency level at this. So they fix it. So China deliberately keeps its currency devalued because if it lets its currency appreciate, that will be bad for exporters, right? So keep that, right? Currency appreciation, bad for exporters. Currency depreciation, like which is that's why Indian government is allowing that, right? So it is good for exporters and vice versa, right? So currency appreciation, uh, basically exports will go down, right? Appreciation bad for exporter, good for importers, good for importers, opposite. And similarly, currency depreciation, vice versa. I'm not writing again, but vice versa. But remember it. And currency response time frame, right? Currency effect takes over longer period, right? It generally doesn't happen very fast, uh, right? Currency effects on trade volumes occur over longer period, response to persistent trends, not your short-term volatility. That's why government generally doesn't every government doesn't interfere every day, right? So that's what we have. Okay, but best way to remember how I have remembered whole my life: China keeps its currency devalued. Why? Because China business model is export. You know that iPhones made in China, everything made in China, right? So why China's exports are so competitive? Because they deliberately keep their currency down. If currency goes up for them, it will be bad for export. They will suffer massive losses. Right? So they don't let it go up. Again, currency is a very difficult topic to understand, right? It takes, like, if you feel little confused here, so I'm just trying to pacify you that currency is a one of the most the understanding currency at a macro level, how supply, how demand, how trades, how tariffs, how macro environment, GDP affecting currency. It's a work of a very specialized work, right? It needs very deep understanding, not easy to understand. But this is a good start, at least, CFA level 1, you are learning this. Okay. Then we have business cycle characteristics. I think this is easy, right? We have already seen that. Trough, when we talk about trough, is where the GDP growth turns negative to positive. High unemployment, right? Keep that in mind. Your increase over time and your temporary workers, right? Durable goods and housing spending may rise. Inflation is moderate or decreasing inflation rate. Expansion, GDP growth accelerates, unemployment rate decreases, or hiring accelerates. Investment in equipment and housing pricing or housing rises. Your inflation may increase. The right imports kind of increase, right? So that is what we have. Again, this will help you to just know it better. Then we have your peaks and troughs. Very easy. Again, peaks and troughs. Peaks is GDP growth kind of now slows. You have gone up on the top part, it kind of slows. Hiring kind of slows, right? Spending and investment grow more, inflation rate increases. Contraction, your contraction, GDP growth kind of becomes negative, right? Hour worked kind of decreases, unemployment rate increases, your consumer spending, housing and investment activity decreases, face decline, inflation rate decreases with the lag, right? Imports decrease and domestic income growth slows, right? Okay, then we have this, and then we have the economic indicators. Economic indicators are your statistics, right? Statistics used to assess your current conditions and future directions of the economy. Okay, and you have leading indicators, you have coincident indicator, lagging indicator. Leading indicators are something which uh, turn before the business cycle, right? So you should know, right? See, this is a very this is a very important slide, right? Like, I have seen very smart people not knowing this. That's why I love CFA, right? To be fair, if I have to compare CFA, FRM, CQF, right? CQF is coding and all that dominant, right? But if you want to learn real stuff, right? Real macro thing, right? That knowledge CFA gives very clearly, right? I have seen a lot of very smart people not knowing this, that you should be very clear that what are leading indicators. These are something which will tell you before something has happened, right? So track average weekly hours. If you want to know before anyone what is going, like ultimately this is the skill now. You want to learn now that what will happen in future. This is a leading indicator. This will tell you beforehand. Initial claims for unemployment. Again, that's why every Thursday, right? Every Thursday, the claims for unemployment comes out on Bloomberg, right? So people watch that. Smart people watch that. Manufacturing new order. This report also comes out every 15 days once. Consumer expectation. Michigan survey. This is Michigan survey. This is what Bloomberg tracks every week, right? You see these reports every week or every 15 days on Bloomberg, and people watch it clearly. Your, your stock, your index reacts to S&P reacts to these things, right? Then coincident is something which turn with the business cycle, right? Example is your non-farm employment, your personal income, industrial production, right? And lagging is which turn after the cycle, right? So average judicial unemployment. So that is why nobody actually pays attention to lagging indicator, right? People are all worried about making money in the market, right? So everybody is focused on leading, right? So keep that in mind. But again, for example purpose, you should know leading versus coincident versus your lagging. For stock market people, leading are the most important thing, right? And that is why they pay so much attention. Okay. All right. I think we have completed the chapter. Now we have to just do questions. The chapter is over, right? So question number 4: the indicator indexes created by various organization or research agency, right? Now indicator indexes, right? So include only leading indicators to compute the value? No, right? So they don't include only leading indicator, right? Because indexes include more than only leading indicators, right? Only leading indicators, no, right? Are highly leveraged signals on the phase of business cycles? No, they are useful, but not are highly reliable. No, they are useful, but highly reliable. No, pretty reliable, right? We can say, but highly reliable is a bad word, right? Because they can give you some idea, but not totally, right? Evolve over times in composition competition formula. Right? This is the answer. Easy, very easy stuff, right? Remember that. They're all CFA book question, guys. Right? Which one of the following trends in various economic indicator is most consistent with the recovery from a recession? Now, when we talk about recovery from a recession, a declining inventory sales ratio and stable industrial production index. No, stable industrial production does not confirm your recovery, right? So stable industrial production, right? If you're recovering, it will increase. So that goes away, right? A rising broad stock market index and unit labor costs turning from increasing to decreasing, right? See, unit labor costs are your lagging indicator, right? These are lagging indicator, right? So this will not give you the value, right? So we are talking about recovery from a recession, right? So now, since unit labor costs are kind of lagging indicator, so labor cost kind of, right? Unit labor cost kind of peak, right? So how will I say? Let me write down. Unit labor cost are lagging and peaking is more like recession. So remember this line that your it is more like, because we are talking about recovery from recession. Recession, they will be peaking, right? Peaking, not increasing to decreasing, right? Turning from increasing to decreasing, right? Peaking is more like it, right? So this is a little tricky. So this also goes away, right? So third one is a decrease in average weekly initial claims for unemployment insurance and increase in aggregation real personal income, right? So this is like a leading indicator, right? So very tricky kind of question, because initial employment claims, right? When you look at initial claim. This is a leading indicator, right? This is a leading indicator. So whenever you see something, growing, right, that shows that, oh, it is recovering from a recession, right? So that is why it is so important. Leading indicator, aggregate real personal income, uh, kind of confirms your increase in aggregate real purpose, right? Confirms your recovery kind of thing, right? So again, tricky. Like this question, third question is a little tricky. Uh, you have to have a clear idea what is lagging and leading. And leading will tell you, lagging will only come after everything has happened. Leading will tell you beforehand, right? So first of all, you need to have that distinction, what is lagging and leading. Okay. Uh, Very tricky, right? Next one, practice question number 6. Which of the following statement gives the best description of nowcasting? Nowcasting, again, this is basically nowcasting. If you talk about, focuses on estimating the present state of your economy. Okay, so it is like current GDP, etc. Okay, what happens here is you use your real time high frequency data to assess your current conditions. This was not discussed in your notes, but I'm just giving you an idea so that you understand, right? Basically, this method is used to forecast future trends in economy based on their past and current value. No, it is not. Basically, this is more about. It is not about. If you are using your past and your current values, that is more like forecasting. This is called forecasting. There is something called forecasting. There is something called nowcasting, right? So this method is used for real-time monitoring. This second one is what, again, this is the definition. This method is used for your real-time monitoring of economic and financial variable, current conditions and estimate of current state. This is your nowcast, right? And this method is used to study past relationship between variables, determine which one is paid, right? This is historical analysis. This is analysis. Nothing with the nowcasting and forecasting. But know the difference between forecasting and nowcasting. Very important. Okay. Then we have next one. Your best description. Which of the following statement is the best description, right? Which of the following? Okay. Which of the following statement is the best description of the characteristics of economic indicator, right? So again, leading indicators are important because they track the entire economy. No, nobody is tracking the entire economy. So that is wrong. Lagging indicators in measuring past condition do not require revisions, right? No, they can be revised and just keep on happening. They can be revised. So don't be surprised if they are revised. Happens all the time, leading, lagging, although. A combination of leading and coincident indicators can offer effective forecast, yes. Okay. Okay, this is done. Question number 8, right? When the spread between 10-year US Treasury yield and the short-term federal fund rate, okay, very interesting, narrows, right? So 10-year US Treasury yield and short-term federal fund rate narrows, and at the same time, the prime rate stayed unchanged. This mix of indicator most likely forecast future economic what? See, the idea is that if your prime rate, or let me write it down. This is This is actually a practical thing used, right? So please keep in mind when you talk about yield, right? Yield spread, right? Yield spread, right, is a leading indicator. Okay. When you have your narrow spread, when you have narrow spread, which the question says, right? This narrow, right? Narrow spread signals. This is a complex question, guys. Signals slowing growth or your recession risk, right? So something is when the spread kind of, and yield spread is what? Yield spread is your this 10-year treasury yield, 10-year treasury yield minus your federal fund rate. 10-year treasury yield minus federal fund rate. That is called yield spread. And this is a leading indicator. Remember that. And when that narrow, right, it means recession risk, right? Prime rate, this one, right? I'm writing it down. So this you have to remember. There is no way you can learn these things without remembering. Prime rate is lagging. Okay, and lagging, and typically, obviously, lagging indicator kind of adjusts, right? So basically, you know that it's a recession you are getting when it is narrowing, right? So recession is you are getting decline. The answer is B. It's very straight. Like, see, these are concepts which, if you remember and keep in mind, these are very straightforward questions. Okay. Question number 9. Current, and again CFA, and that's why we are doing this question. These are the exact exam questions, right? We have to master, right? Now, current economic statistics indicating little change in service inflation. Again, a very Bloomberg type question. Little change in service inflation, rising residential building permits, increasing average duration of unemployment. What is best interpreted as? Again, I'm writing it here. When you have residential building permits, right? This is a leading indicator, right? How many people are issued residential permits, right? So if your residential permits are rising, right? It means rising means that it is a future expansion. Means people are building houses to sell and the expansion is happening, right? Moving on to the next one, right? Then we have your average duration. Average duration of your unemployment, right? This is a lagging indicator. Okay. So now if average duration of unemployment is also increasing, right? It means lagging indicator also increasing, means downturn already occurred. Because it is happening, the report comes out late, na? Already happened. Okay. Service inflation is also, if you look at service inflation, this is lagging, right? So if you have little change means it is neutral. Okay. So now, if you see your leading indicator is rising, plus your lagging indicators is saying that, lagging indicator is saying, see, lagging indicator doesn't mean much, to be fair. If your leading indicator is rising and your lagging indicator is reflecting your past weakness, so you are looking at a upturn, right? Because ultimately you have to see leading one. Na? So if you look at first one, conflicting evidence about the direction of economy, no, indicators are not conflicting if you consider the timing, right? Because this is leading, this is lagging, right? So if you know that this will take more, preference, because this has already happened. This is happening. This is happening, right? So we will give priority to this one. So it's not a conflicting evidence. Evidence that a cyclical upturn is expected to occur in the future, yes. Future expansion, yes. Right, that is what we are looking. Evidence cyclical downturn is expected, no, expected to occur in not. That has already happened, right? So answer is B. So this is what makes a good analyst, right? He say that, okay, fine. Now I understand things better because if the one report is this, one report is that, you can easily judge, right? Which one is you have to follow, which you don't have to follow. If relative to prior values of the respective indicator, the inventory sales ratio has risen, right? If inventory sales ratio has gone up, unit labor cost is stable, right? Real personal income has decreased, right? Again, very like, see, I am answering this question very fast because I work in this sector, but you will take time to answer, right? So if I'm saying inventory sales ratio, again, and you have to do the hard work, guys. I have also done when I was a student, right? There's no way you can survive this without sitting with it for few hours, right? It doesn't come to your mind so easily, and you have to remember few things also. If inventory sales ratio, first of all, understand this is the lagging indicator, right? So first of all, is this lagging or leading? Lagging, right? So lagging, I'll not pay much attention because it is telling me about the past thing which has happened, right? Inventory sale ratio has risen, right? So it was past, right? If unit labor cost I'm talking about, unit labor cost is again lagging. I'm not bothered much about this, right? If your real personal income, right? This is your coincident, right? So I first of all got this that okay, that lagging coincident, right? So now my question is that if you have a lagging indicator and your coincident indicator, uh, it does it means uh, if you look at the coincident one, real personal income has decreased, right? So coincident happens at that time, right? So is if somebody says it's just about to occur, no. Leading will tell that, right? There is nothing leading here. About to occur is leading, na. This goes away directly. Will occur sometime in future. This also goes away. When you have lagging and coincident, it is like just occurred or just occurring, right? So has occurred. Right? Two are lagging and one is coincident. So occurred is more, right? This is again typical, right? It is not easy, but again, leading is not there, so you're not getting any idea about your this thing. Okay, then okay, question number 11, but it's tough, right? These are questions are not easy. When aggregated real personal income, industrial output, and the S&P 500 index all increase in a given period. Real personal income, coincident. Industrial output, coincident. S&P index leading. So this is S&P index leading. This is coincident. This is coincident. Right? It is most accurate to conclude that the cyclical upturn is what? Right? About to end? No. Leading is saying up now, so it is occurring, right? About to end, about to occurring, or like this is important, right? Now you will think that is occurring or about to begin. Again, two are coincident, so majority is coincident, right? So coincident is like, so it is occurring or about to begin. So it is occurring. Coincident is a two, na? So it is occurring, not about to begin. If all were, if there were two leading, then I will say about to begin, right? So the majority is with the coincident. Again, difficult, right? So practice, practice, practice. All the questions, difficult questions I'm doing here, right? Next one, which of the following is most likely to increase after an increase in aggregated real personal income. So if your aggregated real personal income increases, does it have an effect on equity prices? See, aggregated real personal income is what? Aggregated real personal income is coincident. Right? Real personal income is coincident. Now, if coincident is given, right, please keep in mind that equity prices are leading. Equity prices are leading, so that are not matching. So A will not match. Building permits for new which we are asking increase, right? So which of the following is most likely to increase? Building permits for its new private housing unit. This is also leading, right? Building permits also leading. So coincident will not have any effect on leading. So this also goes away. The ratio of your consumer installment debt to income, right? Yes, this is actually lagging. This is actually lagging. The list you will find, you can remember all these, but the ratio of consumer installment debt to income, this is lagging. So coincident will have kind of effect on, not on leading, so only effect is on your lagging one, right? So consumer uh, increases borrowers after your, what you say, after the real personal income increases, right? And that makes sense, right? When you get higher salary, you go for a higher loan, right? So logically also it makes sense, right? So that is what we have. And then we have the last question, I think, for the day. Question number 13. Which of the following indicator is most appropriate in predicting a turning point in the economy? Now, when you talk about the turning point, is it the industrial production index? No, industrial turning point means we are looking for what you say, leading kind of thing, right? Turning point is you are future prediction, right? So out of these future prediction, you're looking at leading. So average industrial production index, no, this is your coincident. Average bank priming lending rate, lagging. Average weekly hours manufacturing, leading. Please remember all these guys, right? Without remembering all this, it is very difficult to solve these questions. And this is, if you have seen, no, this was not the last question. If you don't remember all this, you will not be able to do it. Then our next question we have, the unemployment rate is considered a lagging indicator because why? See, something is considered a lagging indicator because new job time must be defined to count their workers. See, job classification is not the driver, right? So this is wrong. Multi-work households change jobs at a slower pace. Again, job mobility is irrelevant to your indicator timing, right? So businesses are slow to hire and fire due to related costs. Yes, because there is a delayed response. Something is called a lagging because there is a delayed response to actual economic condition, right? So delayed response to firing or hiring people, that makes it a lagging indicator, right? But again, you have to remember it, right? There is no other way you can solve it. Then we have question number 15. During an economic recovery, right, your lagging unemployment rate is most likely attributable to businesses quickly rehiring workers. No, firms rehire gradually, right? When they fire, they don't immediately hire, right? So they don't hire quickly, right? So when you have economic recovery, you are growing. A lagging unemployment rate most likely attributable to business quickly rehiring. No, that is not possible. New job seeker entering the labor force. Yes, right? So people are fired, which are entering the workforce. So unemployment rate coming after a few days will show, oh, there are a lot of unemployment. So that's why unemployment rate is a lagging indicator, right? So this makes sense. Underemployment, underemployed workers transitioning to higher paying jobs. upgrading effects will not count here because they are going from lower pay to higher pay. That is not unemployment, right? So that will not, right? I hope, by now you must have understood that how confusing it is, right? It is not easy to find your way, right? So especially this, if you see out of 15 questions, leading, lagging is almost like 10 questions, right? Leading, lagging, coincident, right? So spend some time there, go back. Even if you do this 15 questions, which I have done here, you are solid in this chapter. Understand the logic. See, there. What I'll also suggest here is for every one of you is that try to find an easy and reliable way, right? There might be 10 explanations to a theory, right? But if you try to, like, you might have seen when I answer this question, I answer this question in very 2 3 points, 2 3 points, 2 3 points. There is a reason for that, right? The thing is that if you take 5 6 points, you will get confused. So have a very clear cut idea that, okay, when I'm considering this is the thing. This is the thing. This is the thing. So when you have a very clear idea, leading, lagging, coincident. Here you had, we were looking at coincident, right? C made sense, right? Because C was lagging and coincident are almost like same place, not leading, right? So if you have a very clear idea about leading, lagging, coincident, you can answer question very, very fast. Two coincident, one leading, right? So you know that there is nothing called about to happen, about to end, right? It is like two coincident, it is already occurring. Right now it is happening, right? So have but my point here is economics is very confusing. You cannot have 5 theories for one question, right? Because if you generate 5 theories for one question, right now you will feel good. Oh, I solved it in such a difficult way, right? But when you go to exam, you become very confused because all questions will be new. Best way is that having a simple framework, right? That, okay, I look at which category is the indicator, leading, lagging, and then I'll put simple method that, okay, two coincident, one leading means it is occurring, yeah, right, kind of thing, right? If it is two leading and one coincident, it means it is about to happen, right? So have a very simple, clear framework that will happen, that will help you a lot. Okay. Any doubt? Any particular doubt?
Not any particular, but definitely needs a lot of hours to go back.
That's, but this is like, I'll be very honest, make it like, make a page, right? And in page, write all the leading one, all the lagging one, all the coincident one, and paste it in front of your study table, right? That's it, right? That's it. And keep looking at it. You can't remember it one day, right? It is more like you have some mnemonic, etc., and okay, you have very clear, okay, this is leading, this is or out of three, you remember two, right? Then you all know, right? I remember leading and coincident. Whatever is pending is a lagging one, right? So that is also one way, right? But make a list, put it in front of your table, and just keep looking at them whenever you get time. That's the best way to understand these. Okay. All right, guys, we'll stop here and we'll meet tomorrow. Okay. All right. Thank you.